All right, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the broader market. So just a quick disclaimer before we get started. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today will be starting off with the major equity indices, highlighting those key levels. We have seen fairly bullish price action here for the major indices, followed by a breakout yesterday on both the Nasdaq and the S&P, which does bode well for equities to continue their year-end strength. So we'll take a look at where price could potentially head to next. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model as well. We'll take a look at a few subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So kicking off with the S&P 500, looking at the SPY ETF. First thing to note is that we have had some important data coming in the last minute with inflation. So it hasn't really made too much of an impact in terms of pre-market price for the S&P 500. Core inflation has come in line with expectations. So I don't expect to see too much of a move at the open compared to, if we got a higher reading, a higher than expected reading or much lower than expected reading. For now, we see price was consolidating just above that 455 level. And as of yesterday, we saw that breakout there, breaking above 460, now heading towards all-time high territory at that 480 level. So things are looking quite positive for equities across the board. We are definitely having a risk on sentiment in markets. And what I found quite interesting was last week, I know I mentioned last week's webinar that we had non-farm payrolls on Friday. Well, non-farm payrolls came out higher than expected. And over the last year and a half, a higher than expected reading for non-farm payrolls was actually a headwind for equities because it indicated that the labor market was still running hot, and it meant that inflation would be more persistent, given the fact that the labor market is a key contributor to this persistent inflation. Now, we had non-farm payrolls coming out slightly higher than expected, but markets actually reacted positively to that news. As you can see on Friday's price action, we saw price rallying to 460, looking like it could potentially break out already. So this now indicates for me that there's a pivot in terms of how non-farm payrolls are viewed. It indicates a pivot in terms of how markets are viewing inflation as well. For the longest time, we've had a concern that higher interest rates could potentially cause a recession, and that a soft landing was going to be the best possible outcome, i.e., we'll have high interest rates but avoid a recession. Now, with labor data coming in a little bit strong, not much stronger than expected, what we've seen now is markets reacting positively to that news because it indicates that we are avoiding a recession despite having those higher interest rates. So that's how I'm starting to view non-farm payrolls. With inflation coming down as expected, we're going to start looking at a higher non-farm payrolls number as a positive, as opposed to looking at as a negative that we have over the last year and a half. So that's it for the S&P 500. It does look quite bullish here, heading towards all-time high territory at 480. Now, if we move on to the Nasdaq 100, we see a similar breakout. And over the last couple of weeks, we've actually seen a little bit of underperformance for the Nasdaq relative to the S&P. We saw outperformance during the rally, underperformance during this consolidation phase. And a lot of that has to do with the fact that we saw a short-term rotation out of technology. The initial rally was driven by technology stocks, and obviously the Nasdaq 100 has a higher concentration of technology stocks. However, with this very short-term rotation out of technology, which we will discuss during the sector rotational chart segment, we've seen the Nasdaq slightly underperform, but now started to show signs of outperformance relative to the S&P 500, with momentum starting to return back to technology. Technology does have a very good forward guidance for 2024, in my opinion. We're talking about potentially 2 interest rate cuts at least in 2024, and that will have a very positive impact on the technology sector, which is quite sensitive to changes in interest rate policy. So 410 is that all-time high level here for the Nasdaq 100. And price is now heading towards that area. Again, risk on environment. We're seeing how bullish markets are. We're seeing price, bounce strongly from the 340 level once we had a shift in sentiment. And after a small period of consolidation, it's looking like we're gearing up for the second leg after this impulse rally during the summer. Not during the summer, during the last couple of months. So IWM, so we're looking at small caps here with the Russell 2000 ETF. IWM and small caps had outperformance against the S&P and the Nasdaq. When prices were consolidating, small caps were rallying towards this 188 level, which is a 38.2 fib level as well. However, what we have seen is now price running into that resistance zone, which was pretty much expected. And if anything, probably a good thing with price now recovering from that overbought condition, set to open a little bit higher and not respecting it is respecting that resistance zone, but not reversing lower, which does indicate a potential breakout is on the cards. Now, if we do get a breakout in the next few days, look for a rally towards that 200 level. This is a major area of resistance for IWM on the weekly time frame. But from there, we also have 210 to be looking at, which is a 23.6 fib level. So a few key areas to the upside to be noted. And small caps, definitely seems to be experiencing a surge in momentum relative to large caps, which is a positive. Normally, when small caps outperform large caps for a extended time, a couple of months, what we tend to see is it signals a bull market rally. So we could be in store for a very bullish 2024, with interest rates declining. I think that could very well be the case. So TLT, the Treasury Bond ETF, sentiment has clearly changed from a long-term bearish to now shifting to a bullish structure. We can see there has been a break in structure. We can clearly see the capitulation and price actually managing to stay above its 21 and 55-day exponential moving averages, which it hasn't been able to do really since May or so of this year. Limited pullbacks, so a lot of underlying momentum here, and price actually set to open higher this morning. So I do expect to see continuation higher. We have minor resistance at around just below 98, but of course that $100 level is the next key area to the upside. But TLT, definitely looking quite bullish. You want to be looking to buy into those rallies. And as long as US yields decline, we do expect to see TLT to move higher, and interest rate cuts will cause yields to decline naturally. So the US dollar has run into resistance at around that 104 level after a bit of a retracement higher, but structure here in the last, let's say, couple of months does remain quite bearish. We have had a bit of a retracement in the last 2 weeks, but today's price action already looking like it's going to decline even further back towards 102.50 and potentially even lower. So the next key area to the downside is really this $100 level. There's quite a long way to get there, but in an interest rate cutting market or declining market for interest rates, we should see weakness in the US dollar, and for that to continue to move lower in comparison with the other currencies, which the other major central banks are not ready yet to cut interest rates the way the US will be for 2024. And with a weaker dollar comes a rebound in gold. Now, gold created this huge triple top at this 190, 192 area. And last week was pretty much just a pullback for all the 5 days. We saw a significant rejection of that level, and price now declining back towards 183. It is now at that area between the 21 and 55-day exponential moving average, and it's also at a pretty key area at 183, which has acted as support and resistance in the past. Price set to open higher this morning. The risk to reward does favor the upside. And again, as long as US yields continue to move lower and the dollar continues to weaken, that'll always act as a tailwind for gold. The one caveat to that is gold is a safe haven. So if we are in a risk on sentiment, we should technically be seeing some rotation out of gold as a safe haven. But right now, it looks like gold, the price action is prioritizing the fact that the US dollar is declining, and that will provide some support for gold to potentially rally back towards that 192 level and maybe even break above it. Let's see what happens over the next few weeks. So oil has continued to decline. It's been a very strong decline here since breaking below the 83 level. There's a period of consolidation with 80 acting as a minor resistance zone and 74 as a minor support zone. But last week we saw a breakdown below that, a bit of a retracement higher in the recent sessions, and looking like it is going to continue lower towards the next major weekly support level at 66. So we do expect to see weakness in the energy stocks that have a high correlation to oil prices, especially as price for oil continues to decline. So sector rotation, 9 sectors in the improving and leading category and 2 in the lagging and weakening category. This is supposed to say daily, not weekly. My apologies for that, but it is daily sector rotation, which is why we're seeing bigger moves week on week. So in the leading category, real estate's continuing to find that relative strength against the broader market, along with industrials moving further into the leading category. Materials losing out on some momentum with financials, but not too much, nothing to be too concerned about. And discretionary managing to rotate from the weakening category back into the leading category. Now, we do have retail sales numbers coming out on Thursday, which could potentially add some volatility to the sector. So that's still something to keep an eye on. In the weakening category, technology was weakening, but like I said, we're starting to see a bit of a rotation back into technology, hence the outperformance for the major indices and the breakout for the major indices. So technology starting to improve in terms of relative momentum against the broader market, and we could very well see this move higher, depending on how the interest rate discussion goes with the Fed meeting over the next couple of days. In the lagging category, only communications. It has been quite weak against the broader market, but there is also an opportunity for a rebound higher. In the improving category, we have energy continuing to move lower. No surprise there with oil prices declining. But our 3 defensive sectors in healthcare, staples, and utilities showing some pretty decent relative performance against the broader market. I just think with the risk on sentiment that we currently have, it makes more sense to be looking at the sectors in the leading category or even the likes of technology and even discretionary, because they will provide better returns in the long run in a risk on environment than these defensive sectors. Okay, moving on to some subsectors of interest, starting off with DRIV, the Autonomous and Electric Vehicle ETF. I mentioned this last week because I was looking for a potential move towards 25. We haven't quite got that yet, but we have had some consolidation. Price now looking to break above that 23.50 level. And I think a bit of patience here might be required because it's not really showing any bearish structure yet. We've had that rebound, price staying above its exponential moving averages, but just consolidating below this breakout level here. But once we get a breakout, it doesn't look like there's any other key levels up until that 25 zone. So let's keep an eye out for DRIV for a bit longer. And the Jets airline ETF, this I mentioned, almost, I think a month and a half ago when price approached this double bottom zone at the $15 level. We saw that double bottom form, a lot of momentum back into Jets and breaking above its 21 and 55-day exponential moving averages, initially respecting that $17 resistance zone, but managing to break above it and already at that $18.50 level. Price is a little bit overbought, so you may want to take profits on this, or at least partial profits, wait for a bit of a retracement lower before looking for a move higher here for this ETF. But so far playing very well into our hands. We have the next resistance level at 19.50, followed by 22. So a very good longer term buy opportunity here for an airline ETF that has declined quite severely in the last couple of years. And BMY. So BMY was a bullish idea from last week as well. We were looking for potential breakout to the upside after this very strong decline. Price was at an oversold condition, or just shy of that oversold condition, I should say, and now starting to show signs of life, breaking above its 21-day exponential moving average. and with some very bullish price action yesterday. So looking for that continuation higher, potentially back towards that 56 level, but keep an eye out on that 55-day exponential moving average as well. Okay, Zscaler. So Zscaler, I was looking for a steeper pullback last week. We hadn't quite got that, and price is continuing to move higher. This is a name in the technology sector, so we are seeing a lot of momentum into it. The one thing I do like is that momentum has declined to more modest levels after being overbought. So it does look like Zscaler is on track to continue higher and potentially reach this 220, 215, 220 zone in the next few days. So Allstate was a bearish idea from last week. And right now, my concern is that this major resistance level at 145 may get broken to the upside. We saw price declining in momentum as it was approaching this resistance zone, but we saw a big move to the upside yesterday, still within our thesis. But the one good thing was we saw a rejection from that 144, 145 level intraday. Let's see how it plays out in the next couple of days or so, because a break and close above 144 would indicate cutting losses on this trade. But the risk to reward does favor the downside. This rally does look quite overextended, and we are at a major resistance zone. So this bearish idea, in my opinion, still makes sense. But we just have to see how price behaves in the next few days. Okay, and taking a look at Meta. So Meta was a bullish idea when price was at 320 last week, and since then it has performed quite well. We saw a rally towards 326, a bit of a pullback to 325 here, but overall respecting that 55-day exponential moving average, which has provided some dynamic support and still open for that move higher. Again, we'll have to wait and see how this plays out. But we do have some major resistance at around that 350, 360 zone. Okay, and with that, that is all I have for you today. A bit of a shorter market outlook this week. But again, I don't want to add new positions with the Fed meeting this week, with CPI data coming out this week and retail sales numbers this week. It doesn't really make sense to look for new positions when we already have a bit of a mix of bullish and bearish ones. So I think this week is definitely one to maybe sit on your hands, maybe manage your positions, and see what happens with the Fed meeting, looking for any forward guidance in terms of when we could start to see interest rate hikes. But yeah, with that, thank you all so much for joining me, and I will see you tomorrow for an educational webinar on the basics of getting started with options, so a very beginner topic. But I do think it's one of those topics that if you are new to options trading, it's just good to cement the fundamentals and what you should be looking out for when you get started. So again, thank you all, and I will see you tomorrow, if not next week, Tuesday, for another market outlook. Goodbye.